As we approach the end of the year, it's an excellent time to do some tax planning. And you might be busy with holiday events and other deadlines, but you have to remember that some opportunities come with an expiration date. So we're going to talk about some of the bigger tax planning opportunities at the end of the year, and hopefully this will give you some ideas. We're primarily going to focus on some investment and retirement related opportunities, but if you speak with your CPA, speak with a financial professional, you can get a lot more ideas on other things that might be appropriate for you. A first step is going to be to review your situation. So figure out where you stand, how much income you've earned so far for the year, and what is the source of that income? Is it investments? Is it earnings from your job? Is it something else? You want to know the nature of that income and kind of tally all of that up. It's also a good time to review any expenses you've paid and any retirement account contributions, that sort of thing. So as you go through the process, you can often identify opportunities where you might have forgotten to make contributions. And it's important to know how much cash you have on hand in case you do want to spend money on anything, like maybe paying taxes for Roth conversions, for example. As you go through the process, be sure to keep a big picture view. I know how tempting it can be to want to pay as little as possible in any given year, but it might actually make sense to pay some taxes even when you don't have to. So as you look at whatever your goals might be, whether that's retirement income or something else, look at where it might make sense to intentionally pay some taxes. So let's start with some charitable giving. In 2021, it's pretty easy for taxpayers to get a little deduction by making cash contributions to qualifying charities, and that's as a result of some pandemic-related rules that went into place. So you can do up to $300 if you are a single taxpayer, or married filing jointly, that goes up to $600. So if you haven't already reached that limit and you want to do some giving, that's an excellent way to do it. If you want to make some bigger gifts to a charity or to a nonprofit, you can give appreciated securities. And what that means is that you have an investment that has gained value since you originally bought it. Now, if you wanted to just give cash to a nonprofit, you might need to sell that investment, and you have capital gains, so you would owe capital gains taxes on the difference between where you bought and where you sold. But if you just give the investment shares to the nonprofit, like shares of stock or mutual fund shares or ETF shares, for example, then you don't necessarily need to sell the investment and you don't realize the taxable gain. And when you do that, that maximizes what ends up in the charity's hands because you don't have to take out what you would have paid in taxes. And if you're over age 70 and a half, you can potentially do a qualified charitable distribution. That's where you take money directly from, let's say, your IRA, and you send that directly to a charity, a qualifying charity. And by doing that, you get to exclude that distribution from your income. That can be helpful in a variety of ways, basically by keeping it out of your taxable income. This is a good time for a friendly reminder that we can't possibly cover everything in a short video like this. There are probably other opportunities and exceptions and ins and outs that we're just not going to cover here. So you do need to check with a tax expert or do some additional research on your own, and that way you reduce the chances of having any problems. Now on to employer plans. So you might have a few pay periods left to save some money. We're talking about retirement savings on this page. So if you still haven't maxed out an employer plan and you would like to do that, contact your employer, talk with the payroll department, and ask them to adjust your withholding so that you can get up to wherever you want to be. And if you have self-employment income, the deadline to establish a plan is generally December 31st. You don't necessarily need to fund it, but if you want to establish a 401k plan, you typically need to do that by year end. Other types of retirement plans might allow you to establish them next year, next calendar year, but if you're looking at a 401k, this is the time to take action. For those individual tax favored accounts, you may have some extra time. You might have until the tax filing deadline in April. So that's going to be your traditional and Roth IRA contributions, an HSA or a health savings account. You have some extra time to get money into those. Of course, if you set that timeline back by a couple of months, then each year you're going to be a little behind. So it's nice to do that in a calendar year if you're able to do so. If you have investments that have either gained or lost value, there may be an opportunity for you. So a lot of people are familiar with tax loss harvesting. That is when you sell something that has lost money since you bought it and you lock in that loss for tax reasons. And by doing that, you can offset some gains and you can potentially offset some of your taxable income, which can really be helpful. Of course, you want to be mindful of the wash sale rule, so be careful about buying back into a substantially identical security after you do that, but it's something you might use. And then there's also tax gain harvesting. That one surprises a lot of people. You can potentially sell investments that have a gain at a 0% capital gains rate. So you have to be below certain income thresholds for that, but it's really a great strategy if it works for you. Next is to look at your withholding if you're still in your working years. So maybe you're getting a big tax bill at the end of the year. Maybe you're getting a big refund and you would prefer to smooth out your cash flows. Whether you just want to be able to, put money aside each month regularly, or for whatever reason it's causing problems, that's certainly something you can do, and the IRS has a handy withholding calculator you can use to figure out how much might be appropriate for you to withhold. For 2021, those RMDs are back. These are required minimum distributions. So if you are over a certain age, the age has been changing, but let's say 72-ish, then the IRS requires you to take money out of certain retirement accounts. Didn't have to do that in 2020, so you might have gotten out of the rhythm, or you might have turned off some automated distributions, but it's time to get back on track. The penalty for missing an RMD is steep. It's 50% of the amount you were supposed to take. So if you were supposed to get $5,000 out, that's going to be a $2,500 penalty. That's a lot of money and it's hard to stomach. Now, if you are still working and you've got a 401k and you're not an owner of any type or any meaningful type at the company you work for, it's possible that you can hold off on those RMDs, but you want to be very careful. Next, we have Roth conversions. So it could make sense for you to take pre-tax retirement savings, pay some tax on that money on purpose, and then convert it to after-tax Roth money. Now, if you follow all of the IRS rules, you can eventually take that money out tax-free in retirement. This strategy might make sense if you think that tax rates are going to be higher in the future, or if you have a particularly low income this year. So, for example, you might think, I'm okay with paying taxes at whatever the cost is this year because I think that's a better deal than whatever I would have to pay in the future. That's a way to go about doing Roth conversions and a good justification for doing so. So this is something that might go away in future years. We really don't know, but there have been some proposals that would get rid of, let's say, backdoor contributions or mega backdoor Roth contributions. So you might even still be able to do the normal Roth conversions. We just don't know how long all of these strategies will last, but be aware that these may be on the chopping block. I can tell you that what I've been hearing from people is that things are taking a lot longer. So if you do want to do something by year end, it's critical to get the ball rolling sooner than later. Start doing your research, start making decisions, because we just don't know how long things are going to take. Everybody is short-staffed, and that includes your investment companies, your custodians, and the people who need to do these transactions for you. So I hope you found this helpful. If so, please leave a quick thumbs up. Thanks for watching, and take care.